If you're a younger investor, age 25 to 45, you're probably trying to figure out all the different stock chart terminology that's out there. Well, I made this video specifically for you to discuss the 5 major chart phases that you need to know: trends, corrections, consolidations, breakouts, and one special one, and how they can help you in your trading to be more successful. Let's get right into it. Jump into number 1 with trends. Starting off with trends, as the name suggests, this is a one-way ticket, either up or down, and it refers to the direction the stock price is moving. Quick example of an uptrend would be something like this, moving higher. Quick example of a downtrend would be something like this, moving lower down here, with a couple pullbacks along the way, but the general overall direction of the trend is either higher or lower. Think about higher highs and lower lows when you're looking for these super big, long, extended trend lines. And this is when, in simple terms, you're thinking of the stock's price is increasing day after day. When it's upwards, there's many more buyers than sellers. When there's a downward trend, there's many more sellers than buyers. So the control is either with the buyers or the sellers. The majority rules out with these long-term trend lines. Next up, we have corrections. And corrections happen within these longer-term trend lines. And for an example here, we're going to draw on our yellow trend line like we had before for this positive uptrend, just like we had before. And what corrections are, they're these little kind of pullbacks here. You can see one right there, these little kind of V shapes that you see, another one right there, all the way along the trend line. The trend line stays intact, but there's a correction where the price becomes too great and it's overbought. There's a little bit of profit taking going on, some selling happens, and the price comes back down to the trend line, but then resumes its overall upwards motion. If you wanted a negative example in a decline with some corrections to the positive upside, you could look at something like this. Overall, this trend line here is very negative. We go from here all the way down, and we have a couple corrections along the way where we come down and we kind of bounce back up. And another time here, we come down, we bounce back up. Those are the corrections in the long-term trend. And these examples, the selling gets too great, and then it becomes too attractive to the buyers. They think they can make a little bit of profit because the stock price gets to a level where it hasn't been for a while. They come in and buy to try to make a quick profit. It gets bought back up a little bit, but the overall trend line continues and the correction is short-lived. Moving to the next chart phase, we have what's known as consolidations, and these occur when the stock price trades within a narrow range. A good example of this, we're going to draw some trend lines like this right now, would be in this area here and here. So the stock price, we're going to tighten it up a little bit right there. So from April of 2019 all the way to November of 2019, almost a solid calendar year, the stock price of the S&P 500 traded within these two lines, the price of 28.20 and 30.48, or let's call it 30.34. This type of price movement is known as a sideways trend because you're not moving lower, you're not moving higher, you're kind of range-bound, ping-ponging in between these two lines, and you're not moving up or down, so you're moving sideways and across. Thus the name a sideways trend. There's no clear winner here. There's no buyer or seller domination, which is why the trend continues for a certain period of time. Then once it's broken to the upside or downside, usually a new bullish breakout trend is established, which you can see here in October of 2019 to the end there into February of 2020. Which brings me to the next topic here is breakouts. Let's zoom in on this and identify this area right here. If we pop this guy open, we can see if we just tighten up our range of support here for our sideways trend, and we're in this little area here, when you have a breakout, it is when the stock price moves above or below these key trend lines. In this case, the stock price broke out above this key trend line that was topped once, twice, 3, 4 times, and then this move right here, boom, right there, we broke above the trend line. And then we retapped it once with this red candle, and we were off to the races, which is when a breakout occurs. You're breaking this major trend line, this major area of support. If we're going to look at an example to the downside after breaking out of the consolidation, it would look like this. Here we've got a consolidation happening. And then if you brought both these lines in, what happens is ultimately it breaks through to the negative side. We can see here that we had this kind of pattern ping-ponging between this little range right here. We had a nice breakout down to the lower side right there, that candlestick. It was then confirmed moving lower, and that's the new trend right there. That's the breakout to the downside, moving lower. And one more chart pattern to understand, and this one is important if you want to be a swing or kind of short-term trader. When you're looking at these charts and you have a trend reversal, this is when the stock price goes from an uptrend to a downtrend or a downtrend to an uptrend. Usually it's followed by an uptrend, then a period of consolidation, then a downtrend will follow. For an example of this, we have a strong uptrend here in the NASDAQ. Okay, we get to a topping out point where the consolidation starts to happen. This is like the one level right there on the bottom. This is the level on the top. Okay. And so you can see we go from this upward trend moving higher. We have this ping-ponging effect going up and down, not breaking through to the low side, but this is the trend dying out. The sellers are coming in and they're saying, we don't want to move higher at this time, even though there are buyers trying to drive the price higher. As you can see, the sellers ultimately win out and the trend goes from bullish or upside to consolidation to downside, and the downside trend continues here and then again with a couple trend corrections along the way, but ultimately it goes from a positive uptrend that was in place for a while and moves lower and lower as it continues to drop. Now the big question that you probably want to know is, how can I use this to my advantage? Well, if you know what an uptrend looks like, you know what a downtrend looks like, you know what trend reversals are, you know what trend corrections are versus consolidations, you can position yourself to make winning trades, either bullish or bearish. You can assume a direction, or you can use stock options like I do and understand where the stock market is likely to go and make your trades accordingly. You can be buying calls, you can be buying puts, you can be selling puts when things are bullish, you can be selling calls as well when you think things are going to be kind of flatlining or moving lower. There are lots of different options, but if you understand this stuff, number one, it gives you a huge advantage and it allows you to make a little bit more return, a little bit more cash flow. So I hope you guys got some value out of this video. Thank you so much for watching, and I will catch you guys on the next one.